Welcome back. Today I want to look about analyzing financial statement, and we are going to look at the statement of cash flows, which is a statement of changes in the financial position of a firm on a cash basis. So we have the categories of cash. We have cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. So let's look each one of them. So cash flows from operating activities. These are operating activities are the basis revenue producing activities of the enterprise. So we have various examples, but let's look at a few. We have cash receipts from sale of goods and letters, cash receipts from fees and commissions, cash payment to suppliers of goods and services, cash payment to and on employees. We also have cash receipts and payment of an insurance company for premiums. We have annuities and other policy benefits, cash payments or refunds tax relating to activities, and cash receipts and payment from contract held for trading purposes. So these are the cash receipts found under the activity. Hope you please take some notes, screenshots as we continue. Write any comment below. I'll get back to you. We have now cash flows from investing activities. So under the investing activities are the acquisition and disposals of long-term assets and investments. That's all fall under investment. Examples of cash flows from investing activity include cash payments to acquire fixed assets, include even the intangibles. Then we have cash receipts from disposals of fixed assets, including intangibles. We also have cash receipts from disposal of shares, warrants, and debt instruments. And then we also have cash advance and loans made to third parties. Then you have cash receipts from the repayment of advance and loans made to third parties. All that fall under investment activities. Let's continue. Let's look at cash flows from financing activities. So at the financing activities, they are sought in the size and composition of the owner's capital, including preference share in case of a company and borrowings of the enterprise. So example include cash proceeds from issuing shares and other similar instrument, cash proceeds from issuing debentures, loan, bond, and other short or long-term borrowings. Then cash repayment of amount borrowed, such as redemption of debentures, bonds, shares. So that is all about the cash flows that we shall be looking at. Hope we are together and look at the method of preparing statement of cash flow. So direct method and the indirect method. So the direct method, whereby major classes of payments are disclosed, whereby the net profit of or loss is adjusted for the transactions of an uncashed deferrals or accruals or future operating payments and items of incomes associated with vesting of financial cash flow. So all these is a fall under method. So we have to adjust the net profit and loss. So let's look at the format. So format, we look at the non-financial institutions. So let's start with cash flow statement, financial price, to the direct method. So we are going to, both in to have the three cash flows from operating and financing. So for the direct method, we are going to start with the cash receipt from operating activities. The cash activities, cash receipts from, as you can see, we have the cash of goods, the cash receipt paid to an employees, cash operations. You also have interest, tax paid before extraordinary item. The extraordinary item, you can name it. And then we have the net cash from operating activities. So then we go to the cash flow from investing activities. So here we are going to have the purchases of property, plant, equipment, the proceeds from sale equipment. You have the interest received, dividend received, and then you get to have the net cash from or used in investing activities. Then we also going to have the cash flow from financing activities. We have the proceed from issuance of share capital, from loan, payment of finance risk liability, the dividends paid. We get the net cash from or used in financing activity. So from there, we can now get the total net increase or decrease in cash and cash equivalent. And also you have to bring down the cash and cash equivalent at the beginning of the period, so that we get the cash and cash equivalent at the end of the period. So this is an example of direct method, whereby we are now using the cash receipts and the cash payment, as you can see. So if you have any question, you can write it below. So you can take some screenshots. So like that. So you can take it in two parts. So let's continue. That was a direct method. Let's look now at the indirect method from that non-financial institution enterprise. As you can see, we have the same scenario. You have to study the cash from operating activities. So in an indirect method, we have to adjust the net profit or loss. So we start with the net profit before taxation and any extraordinary item. So we have to do the adjustment for depreciation, amortization, foreign exchange loss or gain, investment income, loss, and interest expense. So we get the operating profit before working capital, because working capital must be adjusted as well. So we have the operating profit before working capital. So we have increase or decrease in debtors, increase or decrease in inventories, or increase and decrease in trade creditors. So we have to add all that, so that we can obtain now the cash generated from the operations. And here we have to adjust the interest paid, income tax paid. We have to add all this, so that now we can also have the cash flow before extraordinary item. If we have it, extraordinary item, you have to specify it, and then you have now to get the total net cash from operating activities. So those are the scenarios that we do in our indirect method. So we have to adjust the net profit as well as add the the cash from the operating, from the working capitals, which include debtors, inventories, and trade creditors, only the three. Let's continue. Can take a screenshot up to there. Let's introduce now the cash flow from investment activities. Here we include all the purchases. So the purchases of property, plant, and equipment, the proceeds from sale of equipment, interest received, dividend received, so that we get now the net cash flow or used in investing activities. So in the investing activities and finance activity, we don't have so much things, but under the indirect method. The cash flow from financing activity, here we have proceeds from issuance of share capital, proceeds from long-term borrowing, payment of finance risk, liability, dividends paid, so that we get the net cash from or used in financing activities. So that now, after that, we get now the total net increase in cash and cash equivalent at the beginning of the period, and we get the cash, we add the cash and cash equivalent at the beginning of the period, so that at the end we have the cash and cash equivalent at the end of the period. So those are the things that we are supposed to add in our financing activity, and as well as to finalize that. So you can also take the screenshot on the lower part. So that is for indirect method pertaining non-financial institution enterprise. So let's look at the format of a cash flow statement for financial institution enterprise. So we are going to put it like this. So this is the format. I will start the same, all of them, both case scenario have the same format. So we have to start the cash flows from operating activities. So we have interest and commission of receipts. So we also have to add the interest payments. You have the recoveries and loans previously written off. We also have to have the cash payment of employees and suppliers. We also have to have the operating profit before charges in operating assets. So this is what we are going to get before we add anything. So we have the interest and commissions, interest payment, recoveries and loans are previously written off, cash payment of employees and suppliers. So then we are going to get the total of operating profit before charges in operating assets. Then from there we have the increase or decrease in operating assets, where we have the short-term funds, extraordinary item if we have it, the deposits held for regulatory or monetary control purposes. You can also have the fund advance to customers, net increase in credit and receivables, other short-term negotiable securities. So that now we have the increase or decrease in operating liabilities. Please take a screenshot up to there. And then we can also have deposits from customers, can also have negotiable certificate of deposits, net cash. Then we have now the net cash from operating activities, income tax paid. So that now you can have the total net cash from operating activities. So this one has its difference from the non-financial institutions. Let's continue. Here we are going now to look at the cash flow from investing activities. Can range from disposal from subsidiary, maybe wire, dividend received, interest received, proceed from sale of non-dealing security, purchases of non-dealing security, purchases of property, plant and equipment, so that you get the net cash from investing activity. As you can see, the cash flow from investing activity is no different from that one from non-financial activities. So let's continue to cash flow from financing activities. So we have issuance of loan capital, issuance of preference shares by subsidiary undertaking. You have repayment of long-term borrowing, net increase in other borrowing, so that you can now have the net cash from financing activities. Then you have the effects of exchange rate change on cash and cash equivalent, so that now you can have now the total net increase or decrease in cash equivalents or the cash activities. Then you have to add the cash and cash equivalents at the beginning of the period, cash equivalent period. So as you can see, the cash flow from investing and financing activity, they are more the same with that one of the non-financial enterprises. So a minute, take a screenshot up to there, so that you can also take a screenshot on the other upper part of the cash flow from operating activities. So those are the two formats that I wanted to look about, but mostly we are given the question to deal from. We undertake the indirect method using the non-financial institutions. So you should mostly like to learn this method, the indirect method, and especially this part from cash flow from operating activities, since it involves the adjustment and also the working capital. So you should take on that. So let's continue and look at the importance of cash flow statement. So cash flow statement is prepared on cash basis, hence it is useful in evaluating the cash position of an enterprise. Then a projected cash flow statement can be prepared so that it can enable the firm to plan and coordinate its financial operation efficiently. Then you also have comparison of historical and projected cash flow statement will reveal variations in the performance so that the firm can take immediate effective action. Then it indicates whether the firm's short-term paying capacity is improving or deteriorating over a period of time by preparing cash flow statement for a number of years. So this is the part of the importance of cash flow statement. So let's continue. Then it also helps in planning the repayment of loans, replacement of fixed assets. Then it clearly indicates the causes for poor cash position in spite of substantial profit in a firm by throwing light on various application of cash made by the firm. Then lastly, cash flow statement provide information of all activities classified as operating, investing and financing activities. So those are some of the importance of cash flows. So let's look at the limitations of cash flow statement. So as cash flow statement is based on cash basis of accounting, it ignores the basic accounting concept for accrue basis. Then the cash flow statement is not suitable for judging the profitability of a firm, as non-cash charges are ignored while calculating cash flows from operating activities. Again, funds flow statement present a more complete picture than a cash flow statement. then it is difficult to define the term cash under the cash flow statement. So those are the some of the limitations that we can look about. Hope we are together up to that point. Also, I would like you to note that an increase in liability is a source of cash or cash inflow, e.g. increase in creditors implies purchases of goods on credits. So that is an increase in liability. A decrease in liability is an application of cash or outflow, e.g. the salary creditors are paid off. Whereas an increase in asset is an outflow of cash, e.g. goods sold on credit, so that will increase on assets. Where a decrease in assets is an inflow or a source of cash, e.g. sale of stock, cash received from debtors, that will decrease the assets. So it's an inflow in cash. So that is all about the cash flow. Let's look at the ratio analysis. It's also an important topic to look about. So the financial ratios are a relationship determines from a firm's financial information and used for comparison purposes. So these are relationships which determine the information or the financial information of a firm. They can be classified into liquidity ratios. We also have leverage or gearing ratios. We also have activity ratios, profitability ratios, as well as investment or equity ratios. So I hope we are together. You can take a screenshot on that. Please, if you have any comment, let me know. So we are going to look at the uses of ratios. So there are various uses of these ratios. Example, the shareholders, the management, the employees, creditors, potential investment, the government, the customers, all those are, they require to know the ratios of a firm. So let's look at we start with the liquidity ratios. So this measures firm meets its short-term maturing obligation as and when they fall due. So that is calculated under the liquidity ratios. You have the leverage or the gearing ratios. This one measures extent to which a company uses its assets which have been financed by an owner surprise fund. So they have the ratio, they have the financial risk. And also before I forget, in the liquidity ratios, the lower the ratio, the higher the liquidity risk, and the vice versa. But on the gearing ratio, the higher the ratio, the higher the financial risk. So those are the things that we need to understand. And the activity ratios, or the turnover, it can also be known as the turnover ratios. It measures the efficiency with which a firm uses its assets to generate sales. So that is under the activity ratios. Then you have the profitability ratios, which measures the management's effectiveness as shown by returns generated on sale and investment. So that is on profitability ratios. Then you have the investment or equity ratios. So this one is used to evaluate the overall performance of the company. So e.g. determining the company's dividend policy, determining the theoretical value of the company's security, and predicting effects of right issues. So all that we are going to do, their formulas and all that. So that is the definition of each ratios that we are going to look about. So any question up to there as we continue? So we can now look at each and their uses. So we are going to look at the liquidity ratios. We start with the current ratio, which is computed by the current assets divided by the current liabilities. So when the current ratio is of more than 1, means that the company has more current assets than current liabilities. So you should understand that. Let's look at the acid test or the quick ratio. So this one is calculated by dividing the total current. You have the current assets, you subtract the stock, then you divide the total by the current liabilities. So that is the formula for finding the acid test ratio. So the current asset minus the stock all over the current liabilities. So that is all about the liquidity ratios. Now let's look at the gearing or leverage ratios. We're going to start with the debt ratio or capital gearing ratio. So this one will always measure the proportion of debt finance to capital employed by a company. So if a company is highly geared, if the ratio is greater than 50%, so its formula is debt ratio equals to total long-term debt divided by the capital employed. The result you multiply by 100 to get the percentage or the percentage form. Then you have the debt equity ratio. This one will measure the proportion of non-owner supplied funds to owner contribution to the company. So a company will be highly geared if the debt equity ratio is greater than 100%. So the formula is the long-term debt divided by the equity or the net worth. You are going to get the debt equity ratio. So we can also look at the gearing ratio. We also have something called times interest cover. So under the times interest cover, this one shows the number of times earnings by a company cover its current payment. So the higher the ratio, the lower the gearing position, and thus the lower the financial risk. It is calculated by earnings before interest and tax. You add the depreciation all over the interest charge. You are going to get the times interest cover. So any question on the two, liquidity ratio or gearing or leverage ratios, you can write it below. So let's look at another ratio, the profitability ratios. Here you have a few. So we are going to start with the return on capital employed, ROCE. So this one, it will measure the efficiency with which a company uses long-term funds or permanent asset to generate return to shareholders. So we are going to calculate it as profit before interest and tax, or the operating profit divided by the total capital employed. So we are going to get the return on capital employed. It can also be calculated as fixed asset plus net working capital. So you can also calculate it as such, the fixed assets plus the net working capital. Then you have the gross profit margin. This one, the ratio will show how well cost of production has been controlled in relation to distribution and administration cost, whereby you have the gross profit divided by sale, you multiply by 100. So you get the gross profit margin. For the net profit margin, it will measure the firm's ability to control its production, operating and financing cost, whereby you have the net profit divided by sales, multiplied by 100. So you get the net profit margin. Then you have the net asset turnovers, which will give a guide to productive efficient, that is how well assets have been used in generating these sales. So we have the net assets turnover, which will be sales over capital employed. So you get the net assets turnover. Then you also have the operating profit or the margin ratio, which will indicate efficiency in which costs have been controlled in generating profit from sale. Here we have the profit before interest and tax, or the operating profit divided by sale, then all over you multiply by the result you multiply by 100 to get the percentage. So those are the profitability ratios that you can first of all look at. Let's take a screenshot as we continue. So let's look at the other profitability ratios. You also have the operating expense ratios. This one indicates a firm ability to control production and operating costs to generate a given level of sales, whereby we are going to get the operating expense divided by sales multiplied by 100. Then we also have the return on investment, which will measure the efficient with which a company uses its total funds in capital employed to generate returns. So here we have the net profit after tax. You have to divide it by capital employed, so to multiply by 100. So return on investment. We also have return on in which a company or other supplies fund to generate returns to the shareholders. So its efficient will be determined by the earning attributable to equity shareholders. You have to divide by the equity and the result you multiply by 100. So you are going to get the return on equity. Thank you. Hope we are going together. We are on the same track. We can now look at the activity ratios. We start with the debtors turnover, which will show the number of times the debtor pays within the year. So how efficient the firm is in the management of its credit. The higher the ratio, the more efficient the management is in managing its credit. So debtors turnover, you have the credit sale, you have to divide it by the average debtors. Then you also have the debtors days or ratio. So this is also called the average collection period. So we are going to show the average period of credit taken by customers who buy on credit. By the account credit period by suppliers to give an indication of credit administration. So we are going to see this ratio shall be compared by the supplier, whereby we have the average debtors, we divide by the credit sale, the total, we multiply by the number of days in a year, we get the debtors days. And also we can get the number of days in a year, we divide by the debtors turnover. If you have already gotten the debtors turnover, you just need to get the number of days in a year divided by the debtors turnover. Then we are going to look the next, which is credit turnover, which will indicate the number of times creditors are paid by a company during a year. So we have to get the credit purchases, we divide by the average creditors. We get the credit turnover. Then for the credits day or ratio, also known as the average deferral period, so it will indicate the average time that a supplier allows a company to settle its dues. So here we are going to calculate the average creditors. We divide by the credit purchase, the result to multiply the number of days in a year. And if we have the credit turnovers already, we are going to get the number of days in a year. We divide by the creditors turnover, so that we can be able to get the average deferral period or the creditors days ratios. Let's continue. We shall also look at the stock or inventory turnover. This one have to indicate the efficiency of a firm in selling its products so as to generate the cash. It also shows the time stock is turned over or converted into sale within a year. How rapidly stock is being turned into cash through sales. So we have the cost of sale. You have to divide it by the average stock to get the inventory turnover. Then you also have to calculate the stock days or inventory conversion period. So this one will indicate the number of days it takes to convert inventory into sales. So the fewer the number of days, the more the efficient the company is in converting stock into sales. So for stock days, you have the average stock, you divide by the cost of sales, the result you multiply the number of days in a year. So you are going to get the stock days inventory conversion period. Also, we look at the cash working cycle or the working capital cycle. You can also call it operating cycle. So this one is the period for which working capital financing is needed. So they have the working capital cycle, they have the investment in working capital. So we start with its format. We have the average correction period. You have to add the inventory conversion period. Then you less the average deferral periods to get the working capital cycle. So that is the format. Then we also have calculation of the operating cycle. So you have to know how to calculate the operating cycle. So for the inventory conversion period, we call it or we term it, it is the sum of raw material conversion period, work in progress conversion and period, and finished goods conversion period. So when we add all this, the raw material conversion period, work in progress conversion period, and finished goods conversion period, we get the inventory conversion period. So under that, that's when we can calculate each one of them. Like calculating the raw material conversion period, the average time period taken to convert raw material into work in progress. So here we have the raw material inventory. You have to divide it by raw material consumption divided by 360. So after we get the result from raw material consumption divided by 360, we now divide by the raw material inventory. Then you have the work in progress conversion period, which is the average time taken to complete the semi-finished or work in progress, whereby the work in process inventory, you have to divide it by the total of or the result from cost of production divided by 360. Then you have the finished goods conversion period, the time taken to sell the finished goods. The finished goods inventory, you have to divide it by the cost of sale divided by 360. So the 3 will give us now the inventory conversion period, the total or the sum of this raw material, work in progress, finished goods. We also have the debtors conversion period. Time taken to convert the debtors to cash. So it represents the average correction period, whereby we have the debtors, we have to divide it by the credit sale divided by 360. Then you also have the payables deferral period, the average time taken for by the firm to pay its suppliers or the creditors. So you have the creditors divided by the creditors purchase divided by 360. So all that we are going to calculate it to obtain the working cycle or the operating cycle. So in summary, we are going to have the inventory conversion period. You have to add the debt and debtors conversion period. You subtract the creditors deferral period so that you can be able to get the net operating cycle. So hope we are together up to there. If you have any questions or any ratio you have not understood, please let me know. Another ratio that we are going to look is the investment or equity ratios. So here we are going to start with the earnings per shares. So this one indicates the amount shareholder expect to generate in form of earning for every shares invested. So it shows the profitability of company on per share basis, whereby the earning attributable to equity shareholders have to be divided by the number of ordinary shares, so that you get the EPS. Then you have the dividend per shares, which represent the amount of cash dividend that shareholders expect to receive for every share invested in the company. So the total ordinary dividends, you have to divide it by the number of ordinary shares. You have the dividend payout ratio. So this one indicates the proportion of earnings attributable to equity shareholders that are paid out to common shareholders as dividends. It is used to analyze the dividends policy of a firm. So whereby the total common dividends, you have to divide it by the earning attributable or attributed to equity shareholders, or the result you have to multiply by 100. You get the dividend payout ratio. And the dividend per share, or you can use this formula, dividends per share. If you have the EPS, you divide it by the earnings per share, then the result you multiply by 100. So hope we are on the same track as we continue. So let's look at the dividend retention ratio. So here, the retained earnings, you have to divide it by the earnings attributed to equity shareholders. The result you multiply by 100. Then you have the dividend cover. So the earning per share, the EPS, you divide by DPS or dividends per share. You are going to get the dividends cover. Then you have the earning yields. So the measures the potential return that shareholder expect to earn for every shares invested in a company. So it will evaluate the shareholder's returns in relation to the market value of the shares, whereby the earnings per share, the EPS, you have to divide it by the market price per share, the MPS, multiplied by 100. You are going to get the earnings or the earnings yield. We have the dividend yield. This one measures how much an investor expects to receive from cash dividends for every share purchased or invested in a company. So the dividend yield, you have to dividend per shares, DPS, you have to divide it by market price per share, then you multiply by 100, so that you get that dividend yield. Then you have the price earning ratio. So here it will indicate how much an investor is prepared to pay for a company's share given its current earning per share. So the higher the price earning ratio, the more confident investor are that the company will perform well in the future. So you have to get the market price per share, MPS, you divide it by the earning per shares, the EPS. So you are going to know how you are going to understand how much the investor will pay for the company's share, so that he can be able to invest or to be more confident in the future. So those are the users ratios from the investment or the equity ratios. So I think we have covered enough on those users ratios. Now let's look at the limitations of financial ratios. You have different companies use different accounting policy, making comparisons to be unrealistic. So most of the company will use different accounting policy. Another one is that ratios do not take off inflation tendency. So you'll see the ratios are not taking that. Then we also have different company uses different calendar financial years. Yeah, they use the financial, therefore making comparison to be difficult. Then you also have unusual or transient events such as one-time profit from sale on an asset may affect performance and give misleading results. So we also have that one as a limitation. Another one is inaccuracy from financial statement would affect the ratios. So those are some of the limitations that financial or the financial ratios have. So I think that is a well covered topic. Please, if you have any question, don't hesitate to put it on the comment. I'll get back to you. If you have any personalized query, I can offer that. Let me know and I'll keep in touch. Let's study for better tomorrow and always keep in touch. Thank you.